What's going on? Welcome back to the channel. So today I want to talk to you about ticker ON. They did drop their earnings today. I want to go over the absolute key takeaways that you need to be aware of. Aside from that, go over some of the data and what analysts are saying. Before we get into any of that, make sure to hit that thumbs up. And with that, let's get right to it. So they did drop their earnings Monday morning, did go down 8.21%, settling at $47.04. So going into today, the implied move was roughly 8.47%. So pretty much very, very close to on point. Historically speaking, though, there was a good 60% likelihood that they were going to beat. Unfortunately, it didn't really play out as that. Looking at shorts, not saying that this is a squeeze play or anything, but 6.54% of the free float is being shorted. Works out to be 27.7 million shares. Shorts did increase 911,000 shares today. You do see some signs of manipulation, so cost to borrow minimum is negative, meaning that there is brokers out there physically paying people to short this stock. But leading into the earnings, you can kind of see shorts were surprisingly returning. So peak at 6.74 and a low of 6.25. So insinuating maybe the shorts did feel that there was more upside from their earnings. So again, something to keep in mind. But as far as today for options, 4.83 million in calls, 11 million in puts. 52% of all the options being done today were optimistic in nature, and of the call options that were done today, you see a consensus for it to be roughly around that, looks like $53 range, and then the bears are anticipating for it to be sub around 48. So definitely goes to show that there is a little bit more upside based on all of that. With it closing at 47 and change, it is trading between these 2 points, so this S2 and this S3. 41.86 is going to be the next strong target / resistance, so I don't see that being touched, at least for the foreseeable future. Flip side, $47.66 in the short term is going to be one key to really get over in order if you're going to see any sort of recovery. Moving over to analysts, so there was a good handful of ratings. So you had a $60, 85, also 60, 57, 49, and 71. So no new all-time high ratings or anything. Similarly, no, my apologies, there was that new low. So 49 or $49 is that all-time low rating. That was done by Rosenblatt, Kevin, who has a 60% success rating. As a consensus, though, over the last 3 months, $70.72, and that does represent a 50.32% upside. So pretty crazy stuff if you think about it. So let me know your viewpoint on that. So I'm going to go over the absolute key highlights that you need to kind of take away from their earnings for today. Give yourself a shout out if you did buy the dip or whatever else. So let me know your general thoughts. And
on Semiconductor targets $1.35 minus $1.45 billion Q1 E25 revenue amid automotive and industrial demand shifts. Earnings call insights on Semiconductor. Q4 2024 Management View. President and CEO Hassane El-Khoury highlighted that full-year 2024 revenue reached $7.1 billion with non-GAAP gross margin at 45.5%. Fourth quarter revenue was $1.722 billion, with non-GAAP gross margin at 45.3% and EPS at 95. He emphasized ongoing geopolitical uncertainties, inventory digestion challenges, and demand softness across key end markets. Automotive revenue increased 8% sequentially, driven by share gains and new customer ramps, particularly in China, which saw an 18% quarter-over-quarter increase. The acquisition of Qorvo's silicon carbide junction field effect transistor (SiC JFET) business was announced, expected to unlock a $1.3 billion TAM opportunity with a 30% revenue compound annual growth rate through 2030. CFO Thad Trent reported $1.2 billion in free cash flow for 2024, a threefold increase year over year, supported by cost management and capacity planning. He also noted $200 million in Q4 share repurchases, leaving $1.7 billion in remaining authorization. Outlook. Q1 2025 revenue is projected between $1.35 billion and $1.45 billion, with non-GAAP gross margin expected to range from 39% to 41%. Non-GAAP EPS is forecasted between 45 cents and 55. Management anticipates continued volatility due to geopolitical uncertainties and ongoing inventory digestion. Automotive revenue is expected to decline by over 25% sequentially in Q1, with industrial and other segments down mid to high single digits. Efforts to rationalize manufacturing footprint and portfolio are underway, with expected benefits to gross and operating margins materializing by late 2025. Financial results. Q4 2024 automotive revenue was $1.33 billion, up 8% sequentially, while industrial revenue declined 5% to $417 million. Other business revenue dropped 24% quarter over quarter. Non-GAAP operating expenses were $321 million, with a non-GAAP operating margin of 26.7%. Free cash flow for Q4 increased 39% sequentially to $422 million. Inventory levels remained flat quarter over quarter at 216 days, but include 100 days of bridge inventory for silicon carbide transitions, expected to peak in H1 2025. Q&A. Ross Seymour, Deutsche Bank, asked about structural versus cyclical factors behind demand weakness. Hassane El-Khoury clarified that volatility is mostly tied to the non-core business and reiterated the company's strategy to exit highly volatile markets. Vivek Arya, Bank of America Securities, inquired about Q1 sequential trends across segments. Thad Trent indicated automotive would see the largest decline, over 25%, while industrial and other segments are expected to decline mid to high single digits. Toshiya Hari, Goldman Sachs, asked about the automotive outlook. El-Khoury attributed Q1 softness to inventory digestion and extended Chinese New Year shutdowns, but noted that share gains and ramping programs in China and Europe remain intact. Christopher Rolland, Susquehanna, asked about image sensors. El-Khoury noted stability in the segment, with ongoing shifts toward high-value applications like machine vision and robotics. Sentiment analysis. Analysts expressed skepticism regarding near-term demand visibility, particularly in automotive and industrial end markets. Concerns revolved around inventory digestion and weaker-than-expected EV ramp-ups. Management maintained a cautious yet confident tone, emphasizing operational efficiencies and strategic priorities. El-Khoury reiterated, "We remain committed to our long-term strategic goals," signaling confidence in the company's resilience. Compared to the previous quarter, management's tone remained consistent, though more defensive when addressing market uncertainties and Q1 guidance. Quarter-over-quarter comparison. Q4 2024 revenue of $1.72 billion declined from $1.76 billion in Q3, driven by weakening market demand and inventory digestion. Automotive revenue grew sequentially in both quarters, although growth was more pronounced in Q3. Non-GAAP gross margin dipped slightly to 45.3% from 45.5% in Q3. Utilization rates dropped to 59% in Q4, reflecting reduced manufacturing activity compared to 65% in Q3. Management's tone remained cautious, but pivoted toward aggressive structural changes in Q4, with plans to optimize manufacturing and reduce operating expenses. Risks and concerns. Management identified geopolitical uncertainties and persistent inventory digestion as significant headwinds. Automotive demand volatility, particularly in EVs, remains a concern. Driven by tax credit uncertainties and slowing infrastructure deployment, analysts raised questions about underutilization and the potential impact on margins, with management emphasizing the need for cost rationalization and portfolio optimization. Final takeaway. ON Semiconductor navigates a challenging macroeconomic environment by focusing on operational efficiency, strategic investments, and long-term growth opportunities in automotive and industrial markets. While near-term demand remains volatile, particularly in automotive, the company's acquisition of Qorvo's SiC JFET business and focus on high-margin segments positions it for future profitability. Q1 2025 guidance reflects a cautious outlook, but structural changes are expected to drive margin improvements by late 2025.